to the daily insights that matter. We begin today's DITM by talking about India's retail inflation, which is accelerated in the month of September. India's retail inflation accelerated to 7.41% in the month of September from 7% in the month of August, driven by 22-month high food inflation rate of 8.6%. Now, with the latest release, this is the 9th consecutive month where the inflation print has remained above the upper band of the 6% and the second consecutive quarter where the average is higher than the 7% levels. The higher inflation was led by food items. Food inflation surged to a 22-month high of 8.6%. During September, prices of cereals, vegetables, spices, footwear, and fuel rose in double-digit figures. The irregular rainfall is said to be the primary reason behind the higher inflation in vegetables and fruits specifically. Going forward, many analysts believe that the excessive rainfall in early October may adversely impact the Kharif harvest and delay the Rabi sowing, thereby posing a material risk to the food inflation outlook. The inflation could remain sticky at least for a quarter as the pickup in consumer demand during the festive season has encouraged companies to raise the prices. Many companies have also raised prices of consumer goods such as smart TVs, mobiles, garments, and footwear to partly cover the rise in input costs which impacted the profits earlier this year. That being said, the RBI's Monetary Policy Committee, which has already raised interest rates by 190 basis points since May, will be pushed to raise interest rates again as the inflation levels remain well above the RBI's target, with very limited signs of easing in the near term. India's industrial activity contracted for the first time in 18 months in August as manufacturing and mining output plunged. Now, just at a time when the IMF has lowered its GDP growth forecast for India to 6.8%, India's index for industrial production declined by 0.8% in the month of August. Manufacturing, which has a 77% weightage in the index, contracted by 0.7% in August compared to 2.98% growth in the month of July, while mining contracted 3.9% compared to a 3.35% contraction in the month of July. About 9 out of the 22 manufacturing subsectors reported a contraction in output, including leather products, textiles, and electrical equipment. Electrical equipment output declined sharply by 28.2% in August compared to 15.6% in July. Now, the slowdown in IIP for August is a combined effect of the normalizing base and the disappointing performance of the mining and the manufacturing sectors. Now, compared to the pre-pandemic period, the IIP in August has grown by 4%, but it is still lower than the expectations. Now, the pattern of growth across the used base classification also suggests that the consumer demand is likely to witness more headwinds in the coming months from high inflation and the reversal of the interest rate cycle. But the demand for capital or infrastructure goods may continue to get support from the sustained government capex spending. While global growth slowed down, slowing exports and the elevated inflation are the other dampeners for pickup in the industrial activity. It is critical for the consumption in the economy to pick up for the overall growth to be sustained going forward. So what does it mean for you? Despite 190 basis points rise in the interest rates, retail inflation continues to surge above the RBI's target levels. This will prompt the RBI to take additional tightening measures, and hence this will have an indirect negative impact on you. Now, the slowdown in industrial production for the month of August is a dampener, and if the growth doesn't pick up in the upcoming months, it would eventually impact the economic growth of the country. This will have an indirect negative impact on you as well. While I say this is Raj Mehta signing off, wishing you and your loved ones the very best. Thank you.
Did you like watching this video? Then download our app Informed Investor to watch more such informative and interesting videos.